It was another big week. Welcome to the Global Wealth KPI for week-by-week market update, December 7, 2020 to December 11, 2020. Values shut the week lower, driven by the land and monetary areas, as the recuperation in business development gives off an impression of being slowing down and as talks among Republicans and Democrats over another round of financial boost keep on delaying. A deferred improvement bundle represents a headwind for stocks, as additional financial limitations from rising cases tighten development. U.S. laborers asserting joblessness protection unexpectedly surpassed agreement gauges. Emphatically, customer assumption posted an astounding expansion in December in the midst of possibilities for an antibody rollout. Simultaneously, telecommuting and record low home loan rates have driven lodging interest and made an extra $1 trillion in abundance for mortgage holders. Indeed, even as the financial energy eases back in the close to term, we think the standpoint for the economy is positive throughout the following year, however the street might be uneven. Smugness or justified optimism? Major lists arrived at new record highs a week ago prior to pulling back to complete unassumingly lower, as slowed down Washington boost talks and the probability for a no-bargain Brexit soured the state of mind. The market seems, by all accounts, to be to a great extent zeroed in on the possibilities of a more splendid standpoint driven by immunization rollouts, even as late COVID patterns proceed to deteriorate and limitations in movement are reimposed. To this point, the S&P 500 has hit 30 new all-time highs in 2020, 17 of them recorded after the late February pandemic-instigated bear market, and 4 of them recorded the last 2 weeks. Is this amazing strength advocated thinking about the ongoing loss of energy and financial information, or has lack of concern gotten comfortable? We think the appropriate response is yes to both, with various ramifications dependent on time skylines. The pendulum of financial specialist feeling has obviously swung from dread of misfortunes, to dread of passing up a great opportunity, and this could trigger close-term dissatisfactions. Notwithstanding, what makes a difference more for long-haul speculators, in our view, is the possibility of the economy entering another multi-year expansionary cycle that expands the positively trending market into what's to come. Underneath we show a few reasons that help our uplifting standpoint for 1 year from now, alongside some ongoing indications of carelessness that could interfere with the smooth upturn in stocks saw since early November. Explanations behind optimism. Number 1. The rollout of antibodies will probably quicken development and make room for a solid bounce back in monetary action. 1 year from now the economy should be nearer to its typical state on the grounds that the facilitating of limitations and financial resuming will release repressed buyer interest. A getting back to typical ways of managing money will profit hard-hit ventures like relaxation and neighborliness, and it will go about as an impetus for the further recuperating of the work market. Number 2. Corporate benefits, a vital determinant of long-haul returns, are conjectured to develop over 20% in 2021. Up until this point, S&P 500 income have demonstrated stronger than at first expected, upheld by forceful cost control quantifies, the facilitating of credit conditions by national banks, and the U.S. value market's tilt towards innovation and medical care organizations. We accept that lean corporate structures joined with rising income will prompt a wide bounce back in productivity 1 year from now. Offer buybacks, which have been sliced down the middle during the pandemic, will probably continue, adding to income per share development. Number 3. The Fed will stay accommodative and keep its approach rate almost zero even as the economy improves. Verifiably, positively trending markets have finished with the Fed climbing rates to chill off the economy. With joblessness still raised and with critical financial leeway, the Fed will sit tight for in any event the following 2 years. Likewise, under its as of late refreshed arrangement system, the Fed will endure above target expansion to compensate for prior deficiencies. With customer expansion desires moored at low levels following a time of determinedly quieted cost builds, it will take effort for swelling to transcend 2%. Number 4. We expect an augmentation of the financial guide that has been given by governments to connect the pay hole made by the pandemic. A week ago brought some underlying indications of progress, however not an achievement in the boost arrangements in Washington. We presume some gradual trade-offs could be reached as a component of the impending spending bargain before year-end, however a more extensive understanding may be pushed to 2021. Number 5. Since the principal antibody declaration on November 9, a noteworthy expanding of the meeting has occurred. Monetarily touchy ventures, including little capitalization stocks and repetitive areas like energy and financials, have definitively beaten the S&P 500 and cautious speculations. Along with the fixing of high-return security credit spreads, the resource class authority has the DNA of a positively trending market that is in its initial innings. Number 6. New market highs following bear markets have not verifiably shown fatigue. As the table beneath shows, 1 year after the S&P 500 recovered its earlier bear market top, stocks were higher 10 out of multiple times since 1945, with a normal addition of 11%. Nonetheless, the market's advances didn't appear in an orderly fashion higher. Throughout a year the S&P 500 experienced on normal two sizable pullbacks, over 5%, with the maximum decrease averaging 9%. Indications of complacency. Number 1. Following a continuous month-and-a-half-long assembly, the S&P 500 is presently 16% over its 200-day moving normal, demonstrating that energy is expanding. The possibly multiple times in the course of the most recent 30 years when this hole was this wide were in January 2004 and October 2009. In the two examples, forward 1-year returns after that point were positive, however quieted as the market combined the gains won. Be that as it may, with the advantage of knowing the past, this all-encompassing energy appeared in the beginning of a more extended term advance as opposed to the late phase of each particular buyer market. Number 2. Valuations have extended sizably in the course of the most recent 8 months. At multiple times cost to profit 2021 income for each offer, the S&P 500 is the priciest since 2011. We think powerful income development 1 year from now will help valuations standardize, yet at these levels a ton of the uplifting news is now limited. We imagine that some of the following year's benefits were likely maneuvered into 2020, which could mean moderate 2021 value returns. Number 3. The hole between current monetary reality and resource cost stays wide. Applications for first-time joblessness benefits revealed a week ago rose to the most elevated level since September, and progressing joblessness benefits recorded their first increment since August. This recommends that new limitations in action to control the spread of the infection are constraining the work market and posture close-term difficulties to the recuperation. Number 4. A thriving IPO, first sale of stock, market possibly shows that in the midst of record low loan fees and raised money levels, financial specialists are driving themselves farther on the danger range. Notwithstanding a time of high financial vulnerability, 2020 has been the busiest year ever for beginning public contributions that raised more than $1 billion. As indicated by Bloomberg, a week ago's Airbnb and DoorDash IPOs added to the rundown of 30 IPOs on U.S. trades this year to raise in any event $1 billion, almost twofold the earlier record of 18 set in 2014. The speculation scene will never be away from hazards, however we think the blend of financial returning, rising corporate profit, and low loan costs present the defense for an inspirational viewpoint for stocks in 2021. To help explore potential close-term slant swings, we suggest financial specialists follow a restrained speculation measure and keep up appropriate portfolio equilibrium and broadening across resource classes and topographies. That's for this week, and we will come back to you with next week the financial updates. Subscribe the channel and get update as soon as we release. Thank you for watching.